I'm Martin King, property analyst at Edison Investment Research, and I'm joined today by Kenneth MacKenzie from Target Healthcare REIT. Kenneth was founder of the company back in 2013, and he's also chief executive of the investment manager. So there's nobody better placed to talk about the company than Kenneth. So welcome, Kenneth.
Well, we love to talk about the company because we're on a fabulous mission, Martin. The care of seniors should be core to the well-being of our nation.
Kenneth, last week you published the latest quarterly update. It was for the period to the end of December. And it was another period of very strong financial performance with inflation-linked rent reviews driving both earnings and dividend growth, and also a rise in the NAV. There was also some good news on rent collection and also on your capital deployment. Could we start, and perhaps you just give a very brief overview of the quarterly report, but then we can talk, in fact, in more detail on the strategic and operational progress that you're making.
So for sure, NAV went up to 119.4. So there was a 2.7%, I think, return for the quarter, which was encouraging. But the core strategy here from the very beginning has been to invest in modern purpose-built homes, because actually we're only really at the start. We're 13 years old, but we're only really at the start of what's happening in the demographics of our seniors. There's going to be vastly more seniors coming through who will need residential care. The physical real estate around the UK is generally substandard. And so there's a lot more to come. And by being in this critical part of the market, which is future-proof and which is stable, and by signing these very long leases, 35 years, with inflation uplifts, albeit capped at 4%, it puts us in a really good position if you can find operators that love working with you and that are interested in the long-term care of seniors. They make good money, and we make long, stable rents. You made a little reference to rent collection improving. Post-COVID, there was some hiccups from some of the rent collection stuff, but we see that largely behind us, and we're in a really good place on that.
Kenneth, there were a number of re-tenanting projects completed during the quarter, and those are a recurring feature. Could you talk a little bit more about how those and how you work with tenants?
Yeah. So the core part of all of that is, do you have real estate that somebody wants to tenant? And the fact that we have modern purpose-built real estate, and often best in class in the 10-minute drive time, enables us to re-tenant more easily than if it's an old second-hand home. In terms of these recent quarters, there was one particular home where the tenant had challenges across the rest of its portfolio, actually poorer, older homes. And initially, the home that we had with them had been performing well, but he lost focus on it. And while we were intending at that stage to do a consensual re-tenanting, which is what we've done over the years, for the first time in the 13 years of the REIT, we put him into administration, and went through a process where we invited new tenants to come and look after the home. And in fact, we had many offers for the home. And indeed, the offer that we got for that particular home was some £25,000 higher than had been available to us previously, which was pretty encouraging. And that tells you about the quality of the real estate and operators recognizing that these are good homes with good long-term potential. So re-tenanting is something that we do because there's retirals within the sector. There are people wanting to move focus to another area. And the statistic, if it's helpful, is that we have done 23 re-tenantings over the 13 years of homes. But we've had, we think, about 760, this was a few months ago, 760 years of stable income. And it's very, very small, other than what's happened to us this last year, where we ever lose rent. In most of them, it's consensual, rent is paid, and we move on to the next tenant. So it's probably a very important part of what the manager does with deep relationships across the sector.
I know you work with a lot of tenants, Kenneth, over 30 tenants, I think, in your portfolio. You did a very large transaction recently, the largest you've ever done. There were some very good financial and portfolio reasons for doing that, but also a byproduct was spreading the tenant exposures more widely. Would you like to talk about that transaction, but also what you're doing with the proceeds?
Certainly. So that transaction whereby we sold 9 homes at 11% above our holding value, it was related to a tenant that had worked with us from the very beginning. He was a privately owned business, or it was a privately owned business. And in time, they ultimately sold the business to a company called HC1, who are the largest operator. We hadn't chosen to ever have HC1 as a tenant, but we weren't able to stop the transaction, and it was, I'm sure, beneficial for our original tenant. And at the time of the transaction, we said to ourselves, at some stage, we'd be interested in reducing our exposure to that new tenant. And so that was all part of that decision, that at a convenient time and when there was an offer that was attractive to us, that we would do that. And we reduced it from about 16% of our tenant roll to just over 8.5%, 9% of our tenant roll. So that was that transaction. That, of course, enabled us to have quite a lot of money and a little bit of extra cash compared to NAV. And within a couple of months, we made an announcement that we were committing about half of that capital to a new transaction and a new tenant. So that, in fact, today, we have no tenants greater than 10% of our income. We have 4 or 5, around about the 8 or 9% of our income, and then a whole bunch of smaller operators. From the very beginning, again, we decided we would be a highly diversified income source. You and I are old enough to remember Southern Cross and the travesty for shareholders of some of what happened in the sector 10, 15, 20 years ago. And we set out and spoke to all shareholders about recognizing it was an area of risk, but that we would manage it well, and that part of that strategy would be that we would have a highly diversified tenants across the sector. And that is what we have, as you say, mid-30s tenants. And of course, we monitor the performance of all our tenants, probably much more than is common in commercial real estate. So we know occupancy in our homes every Friday night. We know P&L accounts in our home on a quarterly basis. We physically inspect our homes. I think last year we did several hundred physical visits of our homes. There's a group of 4 in the business that is their full-time job, as well as some of my more senior colleagues actively. We love to visit the homes, to be honest, Martin. That is the reality of providing a stable dividend to our shareholders, that the homes are operating well so our rents are stable. So it's an absolute privilege, and it's actually a privilege to see the way carers are looking after our seniors.
And when it comes to redeploying that capital, Kenneth, I know you've got you see a lot of opportunities out there for accretive investments that will enhance the portfolio, provide more care to the ultimate users. Can you say a bit more about the opportunity that you see, how much capital you've still got to deploy?
Yeah, we've got about 100 million to deploy, and the pipeline is well in excess of that. Now, not all of the pipeline will come through to that 100 million be deployed, but because it's well in excess, we expect to be able to deploy that capital expeditiously in the coming year. Typically, net initial yields in our space are around about the 6% level, and that's broadly the pricing that we will deploy at going forward. There's some competition for it, and we will. I think one of the really good places we have got to in the business today, and I sometimes reflect on this compared to 13 years ago, we're seen as a long, stable partner for a number of tenants. They see that our healthcare engagement is quite helpful to their business. And the result of having mid-30s tenants is there's always half a dozen of them saying, we're wondering about this home over here. What do you think of it? And that's with our investment team, a third of their time probably is spent engaging with our own tenants, looking at sites. I sent them a couple of sites this morning that somebody had written me about, and that's a core part of how that all works out now. The site I sent today, if we get interested in it, you'll hear about it in Martin in about 3 or 4 years' time. So there's a lot of work going on in the background which provide the fundamentals to the long, stable income that we're thankful to offer our shareholders.
And the assets that you see to buy, these are all new, modern,
without exception, we will have modern, purpose-built care homes with wet rooms. I think I've spoken to you many times about our view that because of the continence issues in the residents, having continence issues dealt with in the privacy of your own bedroom is what you and I would want. Do to others as you would have them do to you is a golden rule. And we think of that actually also in relation to our shareholders.
Well, going back to the shareholders, obviously there's a bit of a gap between selling assets and buying assets, and that has a little bit of a drag on income in the near term. But as you reinvest and deploy the capital you've got, that will change, and it should see quite a
patience is the name of the game for that, I'm afraid. And you cannot today buy a care home in 6 weeks. There are regulatory as well as legal matters. So you have to work it through in a diligent and careful manner.
Yeah, but you're targeting dividend growth this year, and that on a fully covered basis, and I think that's still the case regardless of any drag. And it sounds as though with the capital deployed at the rates you're talking, that sounds very positive for your progressive dividend policy to be continuing.
We're very thankful for the portfolio we have and the way it's performing and how it's all funded upon robust leases. In many ways, the leases that the sector is now using are largely based on some of what we created 15 years ago. So we're in a good place on that.
Yeah. And largely those earnings are completely divorced from what's going on in the wider economy. And I think people worry about the position of local authorities, but I think overall your portfolio has got much less exposure to that than would be generally the case.
So generally, the sector has about 70% public pay, whereas we're nearly 80% private pay. And one of the big things, I remember you and I speaking 10 years ago, I'm sure, and one of the big changes, when we did the IPO, I remember net worth of the over 65s, the number I think I used was 1.7 trillion, 6.6 trillion today. The sector only sucks up about 25 billion a year of income. 40 years of that doesn't take $1 trillion of it. So plenty. Stay private.
Well, thanks very much, Kenneth. That sounds very good, very promising, and good for shareholders and good for society.
Yes, we're thankful for the opportunity to be able to do this, and we are thankful for our shareholder base being so supportive of the mission.